So I want to get back to that rate cut debate that Jim was just talking about right now. We have a new voice entering that discussion. It's a Fed president saying it's just too soon to be discussing rate cuts. Our Steve Leisman asked John Williams about the market pricing in rate cuts as soon as March. Here's what he had to say.
I just think it's just premature to be even thinking about that question right now. The question that we're thinking about it at the FOMC is, do we have the level of rates right? As Chair Powell said, there's these phases of how we've thought about monetary policy. Have we got this the stance of policy sufficiently restrictive? And then, of course, we'll be watching the data to make sure that we're getting that appropriate policy. To me, the debate is not, it is premature to really think about what we will be doing sometime well into the future. That's not the question in front of us.
All right, John Williams says it's all premature. Let's bring in our next guest, Michael Feroli, Chief U.S. Economist at JPMorgan. Michael, thank you for being here at Post 9.
Good to be here.
So what was your take on what you heard from John Williams? He says it's too premature, but correct me if I'm wrong. We saw the dot plots. It looks like the Fed is talking about it.
Yeah. So I don't think he's totally pouring cold water on the idea of rate cuts. I do think, however, March is probably premature. I mean, that's really 2 meetings from now, only 3 payroll reports between now and then. So I think you'd have to have a pretty significant deterioration in the economy, unlike I don't think what any of us are expecting to get to a March cut. That said, clearly second half cuts are not just what the median dot portrays, but a vast majority of the committee is looking for a number of cuts this year. So I don't think the idea that cutting in next year. So I don't think the idea of cutting in 24 is totally at odds with what Williams is saying, but I do think he's trying to pump the brakes here a little bit on the enthusiasm after Wednesday.
We've seen various points of view about when those cuts are going to come. I had the privilege earlier this week of speaking to Morgan Stanley's chief economist. He believes it's June. We're going to show the audience just a variety of different times that people believe a cut is going to come. When is an appropriate time? When is it not premature to expect that cut to come? And how do you see the market reacting until we get that cut?
Yeah, so we're also at June for a first cut. As I said, we could see earlier only if the labor market really deteriorates. I think June will be appropriate because we'll probably have core PC inflation running by about 2.5% by then, which is, I think, close enough to what the Fed's looking for to start to, as Chair Powell said, dial back some of the restraint. However, if we stall in this progress in inflation that Stephanie mentioned earlier in the second half of this year, then that could push that timing out. But we think June is probably a good placeholder for now.
Yeah, we're just showing the audience for now. Citigroup actually saying July, so kind of further out there. I want to ask you about bond yields. I want to open it up to everybody here, but the action we're seeing on bond yields, what is your take? We're seeing a bond rally, yields are lower. It seems like just that mechanism, stocks go higher. Give us a sense of your outlook of how this plays out for the last couple days of the year.
Yeah, so we were surprised, I suppose, by the intensity of this bond move, right? I mean, right now rates are about what our year-end target for next year is. So we got there really quick. So we do think there's probably some scope for this to reverse a little bit in coming days. But I think fundamentally rates lower from where they were pre-meeting makes sense. However, it was a pretty aggressive move.
Yeah, a really aggressive move on the 10-year, down about 25 basis points from where it was, where it opened the morning of the Fed rate decision. I'm going to open it up to you guys. Michael, you're going to face the gauntlet right now. A lot of questions about where this is all going.
Michael, I'll start with, how about QT? When are they going to address that? Because it certainly sounded like they're not even close to changing their stance on that.
No, I think that was pretty clear in both what Powell and Williams have said, is that QT and the rate cycle are on different tracks. And so our best expectation is that QT probably goes through the end of next year. In other words, even after we're cutting rates, we think the Fed will continue to
And what do you think that does to the yield curve?
Right now, we don't think it's having a really big effect, right? I mean, we do think as QT ends, we could see that have a small effect. But right now, as I said, not a big effect. Yeah.
Michael, what's your call on unemployment? I mean, these numbers that we're seeing, particularly initial weekly jobless claims, are stunning. On an absolute level, 200,000. And directionally, there's just no signs of cracking. What do you think happens?
Yeah, you're right. And we have been pleasantly surprised by how low the unemployment rate has been this year and how strong the job market has been. We still do expect for next year some weakening in overall economic activity as some of the lagged effects of these rate cuts continue to hit the economy. We also think we'll probably get a little bit less fiscal accommodation next year. So on net, we are looking for growth to slow. We do have the unemployment rate drifting a little above 4%, but certainly I don't think, and our expectation is that anything, we're not looking for a recession. And as I said, or as you both pointed out, the claims numbers this week and recently have really been quite phenomenal.
So, Michael, I have a two-part question. How do you feel as a long-term Fed watcher and actually being there for a while about the efficacy of Fed funds futures? Because they were wrong this year. That's part number one. Number two, is there any kind of scenario that you see the Fed does nothing next year?
So in terms of market expectations for the Fed, they've been wrong for a couple years because we as a community have been somewhat wrong on inflation. And we missed how strong this inflation move was going to be in 21 and 22. We missed how strong the disinflation, absent a recession, has been this year. So it's just been a very unusual economic environment, and that's just life, I think.
Yeah.
In terms of your second question was...
is there a scenario that you see that the Fed does nothing?
So I think you would have to have, again, we talked about over the second half of this year, core PCE inflation is running around 2.25%. If that improvement were to cease in the first half of next year, and certainly there are some bear cases on inflation, I think that could leave funds unchanged for the duration of the year. But that would be, I think, a pretty bad turnaround in terms of the inflation news we've been getting.
Michael Feroli, one quick question. Are you given an S&P price target for next year? You got a bull sitting right next to you, bull case 5,400. Where are you sitting at?
So fortunately, I'll leave that to you guys. As a shop, we are a little more cautious on equities for next year.
A wise answer. Michael Feroli, really a pleasure to have you here at Post 9. Thank you very much for being our halftime headliner. Thank you again.